All right, let's talk about something that trips up a ton of people, stock options. Ever looked at a job offer and felt like that part was written in a completely different language? Well, today, we're going to be your translator. We are going to break down the entire process from the day you get them to the day they could turn into some real money.
Seriously, if you've ever stared at a grant agreement with words like cliff, strike price, and ISO, and just felt totally lost, trust me, you are not alone. It's a complex world, for sure, but getting a handle on it is so important. By the end of this, you'll be speaking the language, no problem.
Okay, so what is a stock option at its core? It's really important to get this right. It is not a share of stock. Not yet, anyway. It's simply the right to buy a share later on, at a price that's locked in for you today. Think of it like a really, really good coupon for future stock.
To really wrap our heads around this, we're going to follow the entire life of a stock option. It happens in 4 key stages. First, you have the grant. That's the company's promise to you. Then comes the vesting period, which is basically the waiting game. After that, you've got to make a big decision to exercise. And finally, the part everyone hopes for, the potential sale and the payoff. Let's dive into stage 1.
First up, the promise. You might be wondering, why do companies even do this? Especially startups. Why not just pay more in cash salary? Well, it all comes down to getting everyone on the same page, rowing in the same direction.
Well, for a young company, cash is king, right? It's tight, so equity is this incredible tool they can use to compete for amazing talent they couldn't otherwise afford. But it's so much more than that. It gets the entire team aligned. When the company wins, you win. It's an amazing motivator, it helps keep people around, and it builds this culture where everyone really feels like an owner.
And that brings us to maybe the single most important number in your whole grant agreement, the strike price. This is your personal, locked-in purchase price. So let's say your strike price is $1. And down the road, the company takes off and the stock is worth $50 a share. You still get to buy it for that $1. That $49 difference, that is where the magic happens.
Okay, so you've got the promise, but you don't get the right to all your options on day one. Nope, you have to earn them over time. And that process is called vesting. From the company's point of view, it's how you show your commitment. For you, it's the waiting game.
Let's look at a pretty standard schedule to see how this works. Say you were granted 10,000 options. See that? For the first 11 months, nothing. Zip. Then bam! At the 1-year mark, a full 25% of your options, 2,500 of them, vest all at once. That big event is what everyone calls the cliff. And that 1-year cliff? It's basically the industry standard. It's the company's way of ensuring there's a mutual commitment. If you leave on day 364, you walk away with zero equity. It sounds harsh, but it's really designed to reward the people who stick around for that critical first year. But once you clear that 1-year hurdle, things get a lot smoother. The rest of your options usually start vesting in equal, bite-sized chunks every single month for the next 3 years. That puts you on a nice, steady path to being 100% vested right at your 4-year anniversary. Okay, let's move on, because this next part, it is arguably the most important and definitely the most confusing part of the whole thing: taxes. The type of option you have, either an ISO or an NSO, can have huge consequences for how much money you actually get to keep. Let's put these two side by side. ISOs, or incentive stock options, are just for employees, and they come with some pretty sweet potential tax advantages. The big one? You don't pay regular income tax when you exercise them. NSOs, on the other hand, can be given to anybody, contractors, advisors, you name it. But the moment you exercise them, that gain on paper is taxed as ordinary income, just like it was a bonus in your paycheck. But, and this is a huge but, ISOs have this hidden trap. It's called the Alternative Minimum Tax, or AMT. Just think of it as a whole separate tax system. And if you exercise a lot of ISOs, it can trigger a massive and very surprising tax bill, even if you haven't sold a single share or made a dime in cash yet. So really, it boils down to this fundamental trade-off. As EquityList puts it here, ISOs are designed to give employees a better tax deal, but they're loaded with really strict rules. NSOs are way simpler and give the company more flexibility, but that often comes with a higher and more immediate tax bill for you. All right, let's get to the good part, the part everyone's been waiting for. How does this piece of paper, this promise from the company, actually turn into cold, hard cash in your bank account? Let's talk about realizing the value.
The math itself is surprisingly simple. Here's how you figure it out. Step 1. Find out the current value of one share, what they call the fair market value. Step 2. Subtract your super low locked-in strike price. That difference, that's your profit on each share. Then, for step 3, you just multiply that profit by how many options you have. And there it is, your potential gain before taxes.
But wait, there's one more piece to this puzzle you have to understand to see the real value, and that's a little thing called dilution. As a company grows, it needs to raise money from investors. To do that, it issues brand new shares, which means the total number of shares in the company goes up.
Now this chart right here shows something that feels weird at first, but it's absolutely key. With every funding round, your ownership percentage, your slice of the pie, it actually gets smaller. But here's the cool part. The whole pie is getting so much bigger, so much more valuable, that your smaller slice can end up being worth way, way more money. It's a great trade-off.
Okay, you see the potential now. But here's the thing. Turning that potential into actual money means you have to avoid some common mistakes. So let's do a quick run-through of the biggest pitfalls so you can protect those gains.
First up, for all you ISO holders out there, don't sell too soon. To get the best possible tax rate, the long-term capital gains rate, you gotta meet 2 different timelines. You have to hold the stock for at least 2 years from the day you were granted the options and for at least 1 year from the day you exercise them. If you miss either one of those, your tax bill could go way up. Next up, please, 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 do not get ambushed by the AMT. I know we talked about it, but I'm bringing it up again because it is that important. When you exercise a large number of ISOs, you absolutely have to plan for that potential tax hit. Model it out, talk to a pro, and be ready to set some cash aside so you don't get that nasty surprise.
And for NSOs, watch out for this classic paperwork mistake that could cost you a lot of money. Double counting your income. See, the profit you make when you exercise is considered compensation, so your company already includes it on your W-2. The key is making sure you don't accidentally report that same income a second time when you file your taxes.
And all of this really leads to the single most important piece of advice here. This stuff is complicated, right? The stakes are really high. As Sanjeev Gupta's CPA says, getting help from a tax pro who actually specializes in this stuff isn't a luxury. It's pretty much a necessity if you want to make the best decisions.
So there you have it, the whole journey, from the initial promise all the way to the potential payoff. Understanding the rules, the taxes, the timing, that's what changes your equity from being just a lottery ticket you hope pays off into a real investment plan that you can manage. And that leaves you with a choice. Which one is yours going to be?